Stephen Thomas with Reports on Housing, coming to you again with yet another housing debrief. Thank you so much for joining us, and I just invite everybody to like our channel as well as subscribe. That just helps out with getting more viewers and get this information out to as many people as possible to try to cut through all the noise of all the clickbait titles that are out there. We just want to just cut right through that and get everybody proper information so they can make great decisions for their families and themselves rather than wish upon a star. So if you want a copy of this, you have to be a subscriber to our housing report. We have many housing reports that dot all over SoCal as well as the Bay Area. And the most recent report that came out is called Sluggish Yet No Slide Ahead. We're going to be developing a new report this coming up week, but this is the most recent report. So if you subscribe, you'll actually get this most recent report, Sluggish Yet No Slide Ahead. Yes, inflation has been a total issue. We all know that inflation has been an issue. So I have the update for CPI before we get into our actual housing debrief. And this is CPI. We'll drill down so you can see it a little bit better. I actually went all the way back in time on the series, you could see, so that we encompass both the 70s and 80s outlandish inflation. There are so many people that like to compare to what we've gone through to the inflation of the 70s and 80s. And as you can see in this, that inflation has really come down quite a bit, and it's nothing in comparison to the 70s and 80s. What I am actually pointing to is the purple line. Yes, I really care, like everybody else, about how much fuel cost has risen and the long lines at Costco gas stations because people are trying to obtain the cheapest gasoline that they possibly can. But at the end of the day, I'm looking at core. Core is very important. That purple line, core line, has continued to come down, and some people thought it would go below 3 by the end of this year. I wasn't part of that camp. I am the below 4% by the end of this year, and we're going to get towards target next year. Are we going to make it all the way down to 2? A lot of people say no. There are many vacillating opinions all over the place. I'm one of those people that I kind of don't know, and I just know that we're going to go a lot lower than where we're at right now, and down the road the Fed might have to reconsider what their ultimate goal is. 2% might be too low given the change in the global economy and the way that the global economy works now. So CPI is coming down. Look at core. That is inflation. It's just a basket of goods. This was a better report than what a lot of people were talking about. So I like to listen to economists that this is their livelihood. This is what they do. This is all that they hone in on, is looking at inflation and peeling it apart. And that is their job. It's not about Wall Street traders. It's not about Wall Street economists. It's not about CEOs talking about the overall economy. I like to listen to people that their lane is economics on the inflation side. My lane is housing economics. I won't pretend that I know exactly what's going on with inflation, but I do know, after listening to enough of these really smart people, they've been right. Inflation has been coming down. It will come down. There will be surprises in the data every once in a while. Kind of have one of those surprises with headlines. Not a surprise for anybody that's been following it, so I'm not really that concerned. And which brings us to housing. Will housing crash in 2024? That's the ominous threat that's out there. And that's because everybody constantly goes back to the Great Recession, remembering the Great Recession, remembering the house of cards and all of the pain that was caused by the housing side of things and all the unemployment. And it was just devastating. And there haven't been really that many giant downturns in terms of prices other than the Great Recession and the Great Depression. So for all those people holding out for this giant crash, well, let's peel into the actual underneath of the hood and see what's really going on. So the reason why so many people bring up the Great Recession is because, quite frankly, everybody remembers the burn of 2008. and 2009 and 10, 11, 12, where so many people lost their homes or lost their jobs and really had a hard time during the Great Recession. So because all of us have remembered that, it might have affected us, or it might have it might have impacted somebody we knew, family, relatives, neighbors. That it's just one of those things that we remember. If you a lot of the boomers grew up with either their parents went through the Great Depression or they were really little during the Great Depression. So that at that time period, that changed the way people thought, and they constantly were looking at another Great Depression, just like we're constantly looking at yet another Great Recession. That does not mean it's going to come. So what we've had is housing prices just escalate out of control. They were just going nuts for like several years in a row. And then on top of it, starting last year, we had interest rates going up like crazy. And as a result, we have now this affordable housing crisis where affordability is at a really low level that dates all the way back to like the start of the 1980s. So, and that's when inflation was really crazy as well. So as a result of values going up, and then we had interest rates going up, and we have this affordable housing crisis, many people, they automatically jump to it's going to be a housing crash. And there's plenty of people that have been following this narrative for a very long time. Actually, I've been following people that predates COVID. I have people that have come out and they have YouTube channels where people listen to them all the time, have 100,000 clicks, and they've been talking about over and over again, beating that drum of it's going to be a crash, it's going to be a crash. And yet they have been wrong all along because they're not really understanding the economics behind what fuels a housing crash versus what fuels a housing slowdown. And I'm going to bring it down to the three little pigs. This will make it extremely simple for everybody, but we're going to ditch one of the pigs because we don't really need to talk about the pigs with sticks. Instead, we're going to talk about the two little pigs. And these two little pigs, one built their house and just put together some hay and built this flimsy little house that was so easy for it to be blown down and for there to be a crash, aka prior to the Great Recession. That is what was built. You can compare that to today's housing stock, and it is made out of bricks and mortar. It is not going anywhere. I don't care how much you huff and puff. There's not going to be a crash. The only type of crash that we've seen doesn't really affect homeowners. It affects everybody that's tied to real estate and those people that want to move but can't, or want to buy, can't, because of how high mortgage rates are today. But yet that doesn't impact how great it is that they're sitting in their houses with these extra low rates. So the overall housing stock is extremely strong. And I'm going to give you a comparison. I rarely do this. I hate a lot of words for that go up on any screen, but we're going to walk you through this so that everybody can understand what the differences are and the similarities between the Great Recession housing market versus today's housing market and the lead up to the Great Recession. So the lead up to the Great Recession and during the Great Recession, there was a glut of homes on the market. Today, very limited inventory. The only real similarity in the two markets of yesteryear, Great Recession, and today is very low demand. Low demand back during the Great Recession, very low demand today. Basically, there's very few homes. We look at demand as pending sales. Pending sales activity is way low, partly because homeowners aren't placing their homes in the market, and also it has a lot to do with interest rates making their way towards 8%. There is way too much supply and low demand, which heavily favored buyers. Today, there's low supply and low demand, and they're totally duking it out, and it kind of creates more of a balance. This year, we actually noticed that the supply was so low, it beat the low demand, and we actually had values rise. So low or no down payments were common during the Great Recession. Today, large down payments. Been that way for a long time. Subprime loans, pick-a-payment plans, teaser rate, adjustable mortgages, fraudulent lending, that was predates Great Recession, versus tight qualifications and strict lending standards that all came about with Dodd Frank in 2010. The average buyer FICO score prior to Great Recession, 2006, was 681. The average buyer FICO score most recent quarter, 746 right now. Flood of cash out refinances, homes used as ATMs, people were on boats, yachts, going on trips all over the place, have the fanciest cars. That was predates the Great Recession. And then with higher rates, cash out refinance activity is absolutely plunging. It's almost non-existent. Then you had national delinquency rate for June prior to Great Recession was at 4.7%, and the current national delinquency rate is at 2.7%. It is hovering at record lows. You had $5 trillion of tappable equity. That's the amount of money that can be refinanced and still have 20% equity in your homes. There's $5 trillion across the United States. Today, there's $16 trillion. 23% of all homes had negative equity in 2009 versus 2% of all homes have negative equity today. 31% of all homeowners had no mortgage in 2006. Today, 37% of all homeowners have no mortgage. There's 574,000 BKs per quarter prior to the Great Recession. There's 114,000 bankruptcies for the second quarter of this year. You see the difference across the board. It is very different other than the commonality of no or very low demand. And this shows you about that housing glut. This is very important for everybody to understand. Predating COVID, you could see from around 1999 all the way up to 2006, we had that orange line. That is where the inventory was growing, and it was growing at a time when actually you could see that it was growing at a time when the market was pretty hot during those years. It shouldn't have been growing. The reason it was growing is because slowly but surely you could see that people were getting into more and more pickles because of the kind of mortgages and everything that was done prior to the Great Recession. Then all of a sudden, balloon, we had a lot of homes on the market. We had 4 million homes on the market. So prior to the Great Recession, it made its way up all the way to just close to 2.5 million homes. And then in 2006, almost 3 million, and then 4 million in 2007 on 2006, 2007, that whole range. Then you see what happened. Since the Great Recession, there have been fewer and fewer and fewer homes that have been on the market. It's just the nature of the beast, and I'll explain a little bit more. What happened was there was a credit bubble that was created prior to the Great Recession. Anybody could get a mortgage, and you could see it in the number of purchase applications. There are a lot more people that can potentially purchase a home right now because millennials, that strong demographic patch, have come and they are trying to purchase. So you could see from about 2014 on, yes, we've had an increase in mortgage applications, but it didn't spike like it did prior to the Great Recession. And so you could see how much prior to the Great Recession, it just was this credit bubble versus most recently. It really was not any kind of a credit bubble. We just had an expanding demographic that we were absorbing. And even right now, they want to purchase, but you could see it actually has caved the number of applications because of how high interest rates are right now today. Now, which brings us to, how about the number of bankruptcies? The number of bankruptcies are those red lines. You could see that prior to the Great Recession, you could see that bankruptcies were just climbing like crazy. And in 2006, right around there was a change in bankruptcy laws, but still a lot of people were going bankrupt. And then most recently, you could see this run up of the red lines. It's not that big. You can see that green line. You could see that it's not that big of a run up of bankruptcies. There's not that many personal bankruptcies that are out there. So that's also very important to watch. Now, as far as the national delinquency rate is hovering right now at all-time lows. And as a result, you could see what's happened to distressed. This is distressed homes across all of Southern California. There are 126 short sales and foreclosures available in all of Southern California. And coming out of the Great Recession in as late as 2012, because there was Himalayas to the left, there was close to 12,000 short sales and foreclosures. Banks were in charge of the market back then. So what happened was, in 2010, there was a Dodd Frank Act. And as a result, you could see what happened. Dodd Frank Act just squeezed the heck out of the financial arena and said that you really had to disclose everything that changes, any adjustable rate mortgages. You have to say what it can adjust to. It all has to be in bold print. And as a result, adjustables aren't even done anymore. There's now only kind of adjustables they're fixed for a certain number of years and then they adjust. Very, very few adjustables that are even out there. Most everybody is living in houses with fixed rates or own their homes free and clear. And you could see the credit availability prior to the Great Recession. It was anybody could get a loan. You could, literally dogs and dead people could get a loan back then prior to the Great Recession. And then you flash forward to where we are today and you could see credit availability has totally tightened. And this is, once again, brings us back to the inventory. So inventory is very low. I have that dotted orange line shows you exactly where we are inventory-wise across the United States right now. It's a little over 1 million homes versus 4 million homes during the Great Recession. That white line shows you that the inventory every single year, because of Dodd Frank and the qualification, because you don't have all those adjustable loans and you had fixed rate loans, everybody was purchasing with fixed rate loans, big down payments, they totally qualified for their mortgages. And as a result, people didn't get in pickles. They no longer had to sell their homes when they got in a pickle because they weren't getting in pickles like they did prior. That's what used to fuel our housing markets back in the past, were the volatility of adjustable rate mortgages. And that white line is January of 2020. Every single one of those hills, those little mountains, is a year. And this, at the very left of that mountain, is January. So when you look at January of 2020, prior to the pandemic, it actually was the lowest January on record, dating back to records that were kept all the way back in 1983. What does that tell you? That tells you that slowly but surely the inventory every year was drilling down lower and lower and lower. The lead up to the Great Recession, every year the inventory was climbing higher and higher and higher every January. That is an unhealthy housing inventory, the housing stock, versus right now we have a very healthy housing stock, and it's created a problem of not enough homes on the market. COVID made things worse, and it's like we can't get back to pre-COVID levels. The only areas that are across the country that are getting back to pre-COVID areas are like Boise, Idaho, and Austin. And people like to make big deals about those two areas, but there are their own reasons why they are the way that they are. It's not like the rest of the country is going to move towards that. Now, let's take a look at this. This is where we are as a housing stock. We have homeowners that have strong credit, great jobs, low fixed payments, which are a total hedge against inflation. They're enjoying their rates. They have record tappable equity that we talked about. And you know what? At the end of the day, they're sitting really pretty. The Fed steps in. They're trying to really slow the economy. They bring interest rates up. Interest rates skyrocket upwards. Inflation, because of as a response to how bad inflation is, or was, because we're seeing that it's coming down like they want it to. And as a result, the housing market slowed. But it didn't slow just on the demand side. The Federal Reserve broke both sides. They hammered the market and they said they were going to bring a better balance. The only balance that we have right now is a very, very low supply and very, very low demand, so that nobody's really moving, and they've really hurt the industry. They're not helping the industry. What they wanted to do is create more supply so it would be easier for buyers, but they did not do that. They failed miserably on all accounts. And there's not going to be any panic selling from anybody that's out there going to go, oh my gosh, interest rates are higher. I'm going to go ahead and cash out my low fixed rate mortgage and I'm going to go rent. That's not going to work, because most of them have fixed mortgage payments that are actually less than what they could rent their home out for. So if they really got into a pickle, they could even rent out their home and go move someplace else. So there's not going to be panic selling. This isn't Wall Street. Homeowners don't all of a sudden panic and say, oh my gosh, I got to get out of here. That's not how the commodity of housing works. A home is a home. Everybody needs a roof over their head. Everybody needs to live within a home. If they're owning their home or if they're renting a home, they have to have a home. So there's going to be very few homeowners that are going to opt to sell their house so that they can go rent. And instead, they are just kicking back. 85% of everybody in California has an interest rate at 5% or lower. And as a result, you could see right here in 2022, it was down 19% or missing 51,000 for sale signs compared to COVID. Each one of those bars down is the month compared to the three years prior to COVID for that month, 2017, 18, and 19. So you can see every single month in 2022, fewer homes compared to the average prior to COVID. And nearly almost every month, very, very similar number of homes come on the market when you compare them on a monthly basis. In 2023 so far, it even got worse. There are now missing 87,000 for sale signs, and that's just through September. There's still the fourth quarter of 2023 to go through. So missing a gargantuan slice of the real estate inventory, just pulled out of the market because everybody's enjoying their loan, staying in their home. They're just kicking back, knowing that they've got this great fixed loan low rate. So we're totally in uncharted waters. The Federal Reserve, they can pretend like they know exactly where we're going, but I'm here to tell you that that's not what's really occurring. Every single quarter they come out with this dot plot. Starting in December of 2021, that's when they started to get a little bit aggressive, and they said that we're going to start to really raise things a lot more than what we just said in September of 2021. In September of 2021, they said there would be one 25% bump for all of 2022. There were for a total of 0.25%. Instead, we had a 4.5% bump with 7 hikes in 2022. So they had no idea in September of 2021. They really didn't know how much they were going to go in December of 2021. And then every quarter they come out again. The most recent one was just last month, September of 2023, and their dots got a little more aggressive. They said next year we're going to have interest rates that are going to be 0.5% higher than what we originally had anticipated. But I'm here to tell you that the Fed has no clue where we're going forward. They can pretend. And then they even added on here 2026. That seriously is insane to even pretend that they know where they're going to be in a couple of years, let alone next year or 2025 for that matter. The overall economy is too hot. They don't like how hot the economy is. Every time we have a jobs report come out, everybody wigs out. And they're leaving government bonds. And the reason I always bring up government bonds, and a lot of people talk about 10-year treasuries versus interest rates, is because the overall investor that's out there is looking at both bonds and mortgage-backed securities. So like 10-year treasuries versus mortgage-backed securities, that's the same investor. So when mortgage bonds go up, when the yields go up, so do mortgage-backed securities. So when interest rates go, when bonds yields are going up, interest rates are going up. When bonds are going down, typically interest rates are going down. It's this love affair that's been going on since 1971. That goes back in time. So we know that eventually the economy is going to slow. And there's a number of headwinds that are out there that we could talk about. We can list all day long, and those people that have negative sites talk about them all of the time. If you want to know exactly all the negative things, you can go ahead and listen to all the stuff that they talk about. And as a result, when the overall economy slows down, guess what? There's a safe haven. The safe haven it's not in equities. It is totally in Treasury bonds. They're going to park their money in Treasury bonds. Now, right now, we have an overall hot economy. So that's not what they're not parking their money in a safe haven of Treasury bonds. They have to wait to see that there's a lid on the economy and it's starting to come down before they flood into bonds. And this is where bonds are right now. They're pretty darned high at 4.7%. And you could see from the start of 2022, when we had interest rates as low as like 3.25%, all the way to where we are today, where we are close to 8, you could see that the 10-year Treasury has moved like crazy along with it. And then you can also see that mortgage rates since January 2022 have gone from just about that 3% all the way up to where they are today. It's been this slow, methodical grind to where we are at 7.7%. The last time we were here was November of 2000. You could see how slow this thing, slowly but surely, it went up higher and higher and higher. And so there's this, like I said, the equity markets, Wall Street, traders don't really want to get that involved in it. So they're selling off a lot of their equities. As well as on the bond side of things, they're not looking at US Treasuries either. So what are they doing? If they're not investing in long-term debt and they're not investing in Wall Street, what are they doing? They're sitting on hordes of cash. There's a lot of investors that are sitting on a lot of cash. And why? Because they don't want to get burned. They don't want to buy bonds and then bonds go up even higher because now they've lost money. They want to wait till they know there's an absolute top and then get in when everybody else gets in. And when the economy slows, which I think we're getting towards the top of where this economic thing has gone, and now all of a sudden the economy is going to go the other way. And that is going to be a 2024 story. Could even be later on this year, but we're running out of this year. And eventually something will break. And when that breaks, what will happen? All of that cash that I talked about will flood what? It's going to flood bonds. And when we flood bonds, what's going to happen to rates? Also going to be mortgage-backed securities. We'll see rates come down quite a bit. And then we'll have a lot more demand, a lot more buyers that are able to buy. It will eat into that. It'll make it a more affordable out there when we have interest rates that are lower. And as a result, we'll have more demand. You have to get to below 6% before we start seeing more homes come on the market. Because right now they're kicking back. And some of them might come on when they get down to like 6.5%, more 6%, but even more towards 5.5%. But there'll be a lot more demand than there will be homes on the market. So when you're going out there, you're going to see very few homes still on the market, lots of bidding wars, and values going up instead. That's what happens when we will eventually have a slowdown. When's that going to happen? Shoot, nobody absolutely knows exactly when that's going to happen. If they are saying that they know exactly when that's going to happen, they're lying to you and they're lying to themselves. So, and I just want you guys to know where demand is right now. Demand right now is very low. This is where we're at right now. And you can see it's low compared to where we've been for a super long time. Now, as far as Southern California demand year over year, today it's at 9,518, went down 1%. That's normal. Demand slowly but surely comes down during fall. Last year we were at 10,125, 6% higher. They're squeezing together. Pretty soon we're just going to follow that orange line, the demand of last year. And pre-COVID, that's the 3 years prior to COVID, 15,197, that shouldn't say up 2.4%. That's a lot higher than where we are today. That was a little bit of a typo, that's funny. But what we're dealing with right now is inherent demand. Inherent demand is where there's people that are always going to buy. There are cash buyers that are a bigger percentage of all overall buyers. Why? Because they have cash. They could care less about loans. And there are other people that have a lot of cash in the bank. They're going to get a loan. They could hardly care less. They need something to write off. And they have dual income. That's what we're dealing with. We have people that are getting divorces, people that need to be near kids. There's still people that are saying, I still want to do it. So you have inherent demand. That's what we're dealing with right now. It doesn't, and that doesn't change that much. Match that up against scarcity. And scarcity is what we're dealing with right now. We have very few homes on the market. And you could see that in Southern California, the number of homes on the market. The only time that we had less homes on the market than where we are right now is during COVID. Prior to COVID, a lot more homes on the market. And you could see it in the numbers. Southern California today is at 22,720. Actually went up 4% in nearly 800 homes in the last 2 weeks. It was the largest rise of the year. And the reason that's happening right now is because there are people who are coming on the market that don't understand that the market is slower right now than it was during the summer or the spring, that the market has slowed a little bit. And last year we were at 30,612. That is 35% higher. That's the orange line. And pre-COVID, we were at 41,170. That's the purple line. That's 81%. That's the 3 years prior to COVID. That's at 81% higher than where we are today. We're at 22,000. Prior to COVID, we had 41,170. And where are we going to go from here? This is interesting. We're actually going to be flatlining for about another couple weeks, and then we're going to get towards the holidays. Lo and behold, as soon as we get towards Halloween, the next thing you know, the inventory is done. We should have peaked during the summer, but it will definitely peak like it did last year, typically right around Halloween, and then it's going to come down for the rest of the year. Based upon what we're seeing, because it always comes down, November and December have notoriously the fewest number of homes that come on the market. December is by far the least. We're going to have people that pull their homes off the market for the holidays, and as a result, we're going to start at that black dot where that orange arrow is pointing. We're going to have very few homes in the market. Thank goodness we actually built a little bit of an inventory, so we have inventory bigger than where we started 2022. 2022 was record low inventories that we had not seen in decades, and it was definitely the lowest inventory level per capita that we have ever seen. So that was the start of 2022. But we're still going to be below the start of 2021, which was still really low. And but at least it'll be a little bit more than the start of 2022. That's the good news, silver lining for these higher rates right now. The speed of the market, how fast are we going? Well, today we're at 72 days. It actually increased 4 days in the last 2 weeks. That's a pretty significant slowdown. And last year we were at 91 days at this time period. That's the orange line. And it was really slowing down last year at this time because we were making our way from August, where we had interest rates at 5%, all the way up to 7.37% in a very short window. And we were there in October and November, and you could see what happened to the inventory. So yes, we're adding inventory, not at the rate that we were last year. And then pre-COVID, we were at 83-day expected market time. I know that these numbers used to be a hotter market prior to COVID, but because of these higher rates, as a result, it's actually, I know that 72 is slow enough where we're starting to see some values where it's more of a balanced market. So values aren't going up any longer, and they're not going down in some markets like Orange County, San Diego, but there are areas where we're seeing a slight buyer's market. San Bernardino, Riverside, the Inland Empire, for example. The Bay Area actually has some areas that are pockets of a slowdown, but by in large for all of the Bay Area, they're actually pretty balanced. Now, you can talk all day long about this crash, but we do not have a glut of inventory. This is what a glut of inventory looks like. This is what it looked like prior to the Great Recession and during the Great Recession. We had so many homes on the market, and there was just a ton of homes. Those ton of homes, you could see houses all over the place, foreclosures all over the place. We need foreclosures to fuel this downturn, which we're not going to get. Instead, we have supply and demand totally duking it out. That is what's going on right now. Low supply versus low demand, and they're beating on each other. Right now, the low demand is kind of winning a bit in some markets, and for other markets, it's kind of even right now. So if you want to be a subscriber, go to reportsonhousing.com and please subscribe. The most recent report is sluggish, yet no slide ahead. You'll get a copy of the report. If you want a free month, utilize the coupon code CRASH. And we have a podcast that I think we're filming or doing our 7th episode tomorrow, which will be released next Wednesday. So wherever you like to listen to podcasts, go there. And I just want to thank you for joining us yet again. Sorry this was lengthy, but this is a topic that really has chaps my hide. When I hear constantly, every time that we get this big rate movement, everybody wants to all of a sudden get on the crashing market bandwagon. So thank you for joining us. I appreciate it. Have a super finish to your week, and we will see you on the other side.